Hi, and welcome to our weekly macro roundup, where we talk macro, try to make sense of markets that don't make any sense, and more importantly, answer your questions so we can become better investors. I'm your host, Steven Van Metre, and thanks for being with me here today. Have I got a great show for you today? For my regular listeners, you know I probably got a chicken scratch chart that we're going to go over about why quantitative easing doesn't work as we complete part 2 of my 3-part series on quantitative easing. Does a whole lot less than most people think it does. It certainly does not boost asset prices, certainly doesn't cause stock prices to magically go up, and it does not cause inflation. We're going to dig deeper into this today and really look at the world dollar liquidity cycle and why the Fed is trying to replace a part it can't actually do. Of course, we're going to look at some charts. I want to spend some more time actually looking at some price charts. I know we haven't done this a lot lately. I want to do that today, in addition, of course, to getting to your questions. And I've got a special announcement coming up for that I'm going to let you ahead of time know. On Memorial Day, which is a week from Monday, I normally do not do a video, but on Monday, what I'm going to do is I am going to just answer all of your questions. Now, if I haven't gotten your questions, that's going to be today. I'll announce when the cutoff is to get your questions in. But on the Friday before Memorial Day, I'm going to do my regular video. And as soon as I'm done and it's uploaded, I'm going to turn around and all I'm going to do is go through your questions, put that on Monday on Memorial Day for you. And I'm really looking forward to doing that. So I'll give you a chance to hit me with a bunch of questions then, but just hang tight. I will announce kind of how we're going to do it and what the cutoff is for that. Another question that came in this week is, how do you do your editing where you switch between videos? How do you have the time to cut all this? I don't. This is one, for me right now, this is one cut. This is live. What I say, what happens, this is it. There is zero editing done. I have a little program in the background that switches between my screens with a click of a mouse. So no, this is very much live for me. And I feel not only does it make me better, you actually help make me better by encouraging me to do this one straight run through. All right, so let's look at the macro data from this week. And we saw, following our big win on the consumer price index, on the producer price index, validating we are seeing deflation. And what came out following? We saw South Korean exports down, South Korean prices down, South Korean imports down, Chinese data down. Now in China, we're seeing people go back to work. What we're not seeing is people out spending a lot of money. So deflation is the theme. We know there's more coming. It's baked in the cake. And what's really interesting about deflation in central banks is the Fed is absolutely powerless to stop deflation. It can cause more deflation, which it is, but ultimately the only way we will get inflation is when people actually get out there, borrow money, and spend it out in the real economy. We're not seeing that yet. And there's still all this talk about green shoots. And I think one of the best comments I saw recently on Twitter from Dr. Harold Malgrim, a man I absolutely respect. He's a 2-time presidential economic advisor. If I could spend the weekend with this guy, and he might let me if I asked him, but I would love to. The guy's just a super smart guy. He said, don't misinterpret green shoots for weeds. And I think that's what's interesting about the world of macro and why we go through it together. Because we had a question, I think it was Wednesday, I know it was this week, about where do I go to get data? I go right here where I show you. And then I try to think about it, understand it, and apply it. I don't rely on too many other people. So one of my clients called me today. He says, why do I keep reading that the Fed is printing money when they're not printing money? Don't people know? And I laughed. I said, I don't think they listen to my show. So let's get into the macro data and see what's going on. And the banking data just tells us so much about what's going on. And that's why it's important to look at it every Friday and why we go through it, because I want to know what's really going on. So when I hear green shoots, then I want to see it here. So let's see how the banks were doing. Well, securities and bank credit, so they dropped their holdings of Treasury and agency securities by $10 billion the week ending May 6th. Now, that's pretty interesting. And if we look at a chart of, say, 30-year Treasury yields, what that meant is right here on the 8th, these last 5 days, 1, 2, 3, 4, 5, they dropped 10 billion. And yeah, yields went up, but 10 billion isn't a big number in the Treasury roll. But notice, despite them offloading 10 billion in Treasury securities, it didn't really cause yields to shoot significantly higher. The trend was kind of moving up to retest this 1.4% level before it reversed and headed down. So that's kind of interesting. But it doesn't tell me that there's a big shift here in the direction of Treasury yields. They're still running, over 4 trillion, which is a very high number. In fact, going back this last year, it is the second highest weekly number that we've got. So no big deal that they dropped 10 billion there. Still no big deal that the Fed is backing off by $1.5 billion of purchases a day. People get excited about that. Oh, Steve, but the Fed is cutting their purchases a little bit. It certainly didn't have an impact this week. They've cut now the last several weeks in a row, and yet yields are still falling because we're seeing deflation. Let's keep digging into the data. Loans and leases at all commercial banks up now only 20 billion. So we're seeing a slowdown. That we saw 20 billion last week, 20 billion this week. So we're seeing a trend slowdown, not a slowdown in commercial industrial lending. That is still pretty ridiculous, up almost $50 billion, which is insane. How about real estate loans? You notice there's a big drop of $13 billion here. Now, this to me is unusual. And when I start to see drops like this during times like this, it makes me concerned that perhaps we're seeing people not paying on their mortgages. Is it likely that $13 billion worth of principal payments came in last week? I don't think so, not given the economic landscape. Is it more likely that people stop paying on their mortgage because they're out of work? Yes. So we're starting to see some signs of weakness here, and this is not good. You definitely want to see real estate loans continuing to rise. And where did most of that part of that come from? We saw it in residential and a little bit of commercial. So mostly in residential real estate. Not very good. How about consumer loans? Again, if you're going to look for green shoots, where do you want to find them? You want to find them right here in residential real estate. Obviously not seeing it here. It's been dropping now for a few weeks in a row. But how about consumer loans? These are just getting hammered. And these are down. But where is the bigger issue? Credit cards. Big drop in credit cards. Again, another weekly drop. And what causes that is several things. One, people aren't using them. Potentially there are people that are more financially well-to-do that have not lost their job and said, well, I'm probably not going on vacations here. We have been traveling. I haven't been spending money on this and that. So I'll pay off my credit cards. Sure, that is absolutely going to happen. What's the other side of the story? When you have over 30 million people on the unemployment line, what's the easiest thing to stop making payment on? Your credit card. Right? You still need a roof over your head, so you're going to want to try to make that payment. You're going to need a car to get back to work because you're hoping to go back to work. Credit card, well, maybe that can wait until, later. So this is not a good sign at all that says there are green shoots coming in the economy. So everyone's saying there's going to be a V-shaped recovery and stocks are going to go to the moon and interest rates are going to keep going higher. Well, they're going lower, so they're not going to keep going higher. But anyways, you don't see it in the credit data. And that's what's really nice about this. It comes out around 12:15 p.m. Pacific, and you can quickly kind of run through it and see what's going on. We don't see any big increases in automobile loans, so nothing showing strength here at all. Let's flip over to the PowerPoint slides and look at the M2 money supply. And oh man, all I keep hearing about, and it pains me. It really does. And if you wonder why I can't listen to the news, because all I hear, interest rates are going up, inflation, inflation, inflation. Look, it's right here. There it is. Can't you see it? Inflation, inflation. And man, it's just like eating something I don't like. I can't handle listening to this stuff. Because when you start studying macro, when you start looking at the data, and I'm encouraging you to do that, you start becoming smarter and you start realizing I don't need to listen to all those people. In fact, all they can do is put doubt in my mind because they don't read the underlying data. So I want to go look at that underlying data with you right now. And let's talk about what we're actually seeing. So here's the M2 money supply chart that I've copied over there. And here is the breakdown of it. So what are we looking at? Well, the M2 is made up of the M1 plus some other stuff. And what we're looking at is increases. Well, there's been a slight increase in savings deposit. Is that a big surprise? Not really. Now, that makes sense. But where's one of the largest increases is institutional money funds. And as you may recall from previous episodes, the institutional money fund, this is the cash position you're going to find in your employer-sponsored plans, in your IRA accounts, your Roth IRA accounts, your after-tax investment accounts. So this is institutional or investment money market accounts. So people, despite the market rebounding and everyone thinking there's going to be a V-shaped recovery, they're certainly not showing that with their investment decisions. They are raising cash. And one thing we know is markets will not bottom until this peaks. So there's a big move here. Now, from an inflation standpoint, is this going to get out into the real economy? Are people going to pull this money out of their accounts and spend it? No. At some point, it's going to get reinvested back into stuff, either stocks, bonds, commodities, currencies, precious metals, something. But it usually takes a while because people are worried. Now, where's the other growth coming from? These other checkable deposit at commercial banks and thrift institutions. These are rising. Who is this? Well, these are the commercial banks. And the commercial banks are borrowing money right now, as we've seen, and we'll look at another chart of that. And why are they borrowing money, and is it inflationary? Well, many companies are borrowing money because they're hemorrhaging money because they don't have any. And their earnings are down, profits are down, everything is down. They're losing money and they're borrowing money to hopefully get through until things get better. Now, there are some companies that won't need the money. Let's come back to those who do need it. If you're borrowing money to pay against debt and to just make it through and not turn that borrowing into growth, the money's dead. That's bad debt. It's not leading to growth. Now, there are some companies that we're reading about, they're saying, well, we're taking money, but we're not sure we're going to need it. We're not sure we're going to need all of it. But we're taking it before the banks cut us off. Now, is this money going to flow out into the real economy? No. If a company doesn't need this at a certain point, what are they going to do? They're going to pay back those loans. So when someone tells me, oh my God, look at that money supply chart, it's inflationary. It's not. I'm not seeing inflation here. Now, where would I see inflation in that chart? I'll show you. If all of a sudden savings deposits were just skyrocketing out of the chart, then that tells me consumers and businesses are building up their savings, and savings is future consumption. So right now, I'm not seeing all the rosy green shoots that everybody is talking about. Nevertheless, the growth rate is up here. It is slowing down. And that is kind of critical. We're starting to see it slow down, and that feeds back into what we're going to look at, the money multiplier. Now, the monetary basic, the Fed came out with a new chart of that. The problem is they said it was going to be updated weekly, and it's not. It's updated every other week, so this has not changed. And so the money multiplier went up very slightly. And that's why it has this kind of jagged, you can't really tell here, but it's got a jagged move down because they release the monetary base data every other week. And I was looking forward to having it every week, but we don't. So the fact that the money multiplier went up only slightly, and we know the Fed is still heavy on the gas with quantitative easing, we know that more deflation is coming. This is what this is telling us. So I would expect next week, with the pace of money slowing going into institutional money funds, and the Fed, while slowing, still doing an aggressive amount of quantitative easing, we're going to see another move down in the money multiplier, which eventually will drive stock prices lower and many, many other things. Housing prices, car prices, lots of stuff. How about the real estate market? We saw in the raw data that there's a slowdown here, and the growth rate is dropping down to 4.1. Certainly not what you want. You can still have decent growth rates on a year-over-year basis during recessions, but at some point, though, will fall down. And that is still despite nearly record low interest rates. And the 3-month rate of change is now under 1% and falling. So there's nothing good about the real estate market. So if you're looking for green shoots, not going to find it here. Commercial industrial lending. Now this is still moving up, but it's slowing down its pace as well. It's still ridiculous. I'll assume at some point some of this is paid back. Some of it's defaulted on. Who knows what's going to happen here, but this is not going into growth. And loans and leases and bank credit at all commercial banks, the growth rate is roughly actually, I forgot to update this. I think it's up slightly, but it's flat-ish, and we're still seeing a small rise here, but this is starting to flatten out because real estate growth is slowing against commercial industrial lending. I guess I should have paid more attention instead of just typing the numbers in, but you can kind of see it starting to slow down right here. Again, most of this borrowing, or nearly all of this borrowing, is not going to be fed into growth. It's going to be fed into staying alive from an economic standpoint. And again, here you see another strong view that there's no growth, no green shoots, is consumer credit card growth rate is down. Again, 5.47% from a year ago. This is highly unusual to begin with, and so we're not seeing any form of growth here. When consumers stop using their credit card or stop paying on them, it's not a sign of green shoots. All right, so I want to get into my why quantitative easing doesn't work. Now, fortunately, you don't have to put up with my crudely drawn picture. I've made crudely drawn PowerPoints for you instead. And for those of you who want to read about this, I put this in a written form that we'll post on my website. It's stevenvanmetre.com at 5 p.m. Pacific. So you can go there if you want to kind of get a second look at this. If you prefer, to read about it, I put it into the written word for you. But let's look at, what world dollar liquidity is, how this plays out, why I said before, and I'll stand by this view, that the Fed has to do massive amounts of quantitative easing, but what everyone thinks it does and what it actually does, well, those are two different things. So let's go and take a look at world dollar liquidity. For those of you who are new to the show, how this works is consumers buy foreign goods with borrowed money. Could be businesses, doesn't matter, it's both. Dollars flow to foreign companies. They exchange those dollars for local currency with their local bank, which then exchanges it with the foreign central bank. The foreign central bank stacks up dollars until they become inflationary, and then the foreign central bank buys U.S. Treasury securities at an upcoming U.S. Treasury auction, and then that money is recycled back to the federal government, where it's spent into the real economy, where money is again borrowed, and this cycle continues. This cycle is how inflation and how the dollar expands. When global trade expands, this is expanding. When global trade contracts like it is now, you get deflation. When you have the Fed tightening monetary policy and destroying dollars, see, this cycle creates dollars. When it's working correctly, the Fed and global trade are the two causes of dollar contraction, and we have both of them happening simultaneously. So what happened is, by contracting credit and driving interest rates up, consumers stop buying as many goods, dollars stop flowing, this is a reduction, so I don't mean stop, I don't mean permanently, but fewer dollars flowed into foreign companies, and what happened? The whole cycle started to slow down because of the Fed, and then this kind of doubled up because of the coronavirus, and now all of a sudden the government has less money in the cycle to spend in the real economy because foreigners are not buying our debt, meaning that means Americans have to buy our debt, and Americans hate buying their own debt, and that causes the economy to slow, causes stock prices to fall when we're forced to buy it, and nobody likes that. So what the Fed does is comes in and say, we'll save the day. We're going to come in and do massive amounts of quantitative easing because we were not smart enough to realize that we should never tighten monetary policy, especially to the extent that we did. But don't worry, we got this. Well, they don't. Now you'll notice I did say this. I did not modify this slide. It said it can be restored with massive amounts of quantitative easing. But the problem is the Fed actually can't fix it. This is a scenario where the Fed can lead the consumer to the credit card, but can't make them go spend. So you can lead them to the bank, but can't make them borrow and spend. Because quantitative easing, all it does is it lowers short-term interest rates to try to spur borrowing. It cannot create dollars, as you'll see, to fix the cycle. But it's the only thing the Fed can really do at this point. So let's look at what happens here. So when the Fed tightens monetary policy by raising rates and or reducing its balance sheet, it reduces the quantity of dollars in the world dollar liquidity cycle. This is what it does. The coronavirus, by just canceling vacations, travel, and trade, and people wanting to buy stuff, it does the same thing. So we have a double whammy here. So the Fed then says, hey, no problem. We're going to come in and ease monetary policy. Oh, this should actually say, oh, I just copied this one. This should say, increasing its balance sheet. That's see what happens when you do copy and pasting. I told you this is live for me. So when the Fed eases monetary policy by lowering rates and reducing its this one's right, and raising its balance sheet. Sorry, this side's correct, this side's wrong. It attempts to increase the quantity of dollars in the world dollar liquidity cycle, but it can't, since the Fed can't print money. Here, let me just fix that, because somebody's going to go back and look at this and say, you got it wrong. Lowering rates and or by increasing. Okay, there we go. And boom, there we go. By lowering rates and increasing its balance sheet, it attempts to increase the quantity of dollars, but it can't print money. That's the secret. The Fed does not have the tools, mechanisms, or ability, or the legal authority to print money. So what happens here is, as we get to the cycle where foreign central banks should be buying treasuries, they cut back because they don't have as many dollars. The Fed jumps into the cycle and says, hey, don't worry about it. We'll buy U.S. treasuries. And investors go, yay! And they'll say, look, we got this thing called quantitative easing, and we're going to effectively continue the cycle. But they can't. You notice there's an X here. They cannot continue the cycle because they can't print money. So when the Fed buys U.S. treasuries via quantitative easing from large commercial banks, this is very important, that money that is exchanged with the large commercial banks goes and is held at the Federal Reserve member banks in accounts that the banks cannot withdraw from. So the commercial banks can go and look at their money on deposit, and they cannot withdraw it, period. And because it cannot be withdrawn by the banks, it cannot flow back into the federal government, and it cannot be spent out into the real economy. So you notice all the Fed is doing is they're trying to step in and say, hey, look, every day, everybody, we got this, we're here. And literally they end up doing nothing, but everyone thinks they do something, because the cycle needs to complete. This cycle's got to finish. But the problem is the Fed can't print money, and this money cannot directly leave the Federal Reserve banking system. It can only be used as collateral against loans. So guess what? The cycle is still broken, but everybody believes. And that's why we heard this week Fed Chair Powell say that one of their most important policy tools going forward is called, I was going to say jawboning, but forward guidance. That was what I was looking at, forward guidance. And what that means is we're going to do more stuff. So if you don't believe us, we'll do even more. And if that doesn't work, we'll just tell you we're going to do more. And all that does is try to get people to believe it's working. You know, this is why back when President Reagan faced a double dip recession, the Bureau of Labor Statistics helped him out by fudging the unemployment data. And they did that deliberately to make Americans think that things weren't as bad as they actually were. And as people started to believe more and more jobs were created that really actually weren't, they went out and spent money, and guess what? It created more jobs. So what the Fed is trying to do here is that same idea with monetary policy. It does not work because it doesn't complete the circle. The Fed cannot step in and do this. They're trying to, but it doesn't work. It effectively doesn't do anything. But if it makes people believe it does something, then it does something. Does that make sense? All right. So there you go. Now you can see in my crudely drawn PowerPoint presentation that quantitative easing does not complete the world dollar liquidity cycle, does not lead to the creation of more dollars. All it does is lead to a pile of cash sitting at Federal Reserve banks, And when banks have more cash, it causes short-term rates to go down. And when short-term rates go down, guess what happens to long-term rates? They go down. Let's take a look at this slide from macro charts that I saw this week, and it showed the 30-year U.S. Treasury bond prices. And here we are near a record short position against it. And when you have record short positions, you tend to get a last move higher or a move higher in bond prices. Hence, part of my view that rates are headed to zero. This came from the Washington Post this week. How long businesses could cover expenses with current cash on hand. In 1 month, half of all businesses out. So we see 7% have no cash available. About 10% have 1 to 7 days, 2 weeks, just shy of 15%, 3 to 4 weeks, probably around 18%. Add these up, and what you find is in 1 month, 50% of all small businesses, well, actually it says all business, but it says, I'm going to go with small businesses are out of money. This is bad news for the economy, and yet everybody says there's all these green shoots. Unless the lockdown ends tomorrow, and I'm not going to say proponent or not proponent, I'm just saying unless the lockdown ends tomorrow and consumers run out and spend, like crazy and borrow money like crazy and spend, the situation is going to get worse. So let's take a look at some charts. And let's get back to the 30-year yields. So look at what happened today or this week, it fell below its 50-day moving average. Remember, now everyone's like, it's going to break out. And I said, no, we're just in a consolidation range between 1.4 and 1.2. And then when it sticks at 1.4, it'll head down to 1.2. So what happened today? It went up and it tagged the bottom end of its 50-day moving average. Now, you'll know I'm not a huge fan of trading by or investing by moving averages, but they are important to look at because rallies start and end at the 50-day moving averages. So here's where yields peaked back in late 2018, broke through the 50-day moving average, and then look how yields confirmed, 30 years confirmed the 50-day and went down. Here it tagged it once, tagged a second time, big drop. Let's keep that in mind. Went back up, tagged it, kind of tagged it again, went down. Finally, it crossed over. Everyone, now interest rates are headed higher. Went below, tagged the bottom side, went down, came back up, tagged it, confirmed the downtrend. And look what here, crossed over it, went below it, came up and tagged the bottom side. When that happens, it's confirming, based on the moving averages, that the trend is still intact and yields now are headed lower. And you can do the same with other securities. So let's say you're really excited about energy stocks and you think the energy market's going to make you a ton of money and you want to buy energy stocks and you think you may have missed the bottom. Well, you probably didn't. So we see they crossed the 50-day moving average and looks like they're starting to flatten out. Now let's use this 50-day moving average test to zoom out. And if we zoom out, we can see that here's a point where it crossed over the 50-day moving average, kind of held there and went higher. But look at right here before. 50-day was moving down. It looked like, a double bottom. There we go. Shot through the 50-day moving average. And then what? Kind of started to roll over and then made that next bottom. If we go back to, say, the great financial crisis, you can see heavy volume came down, crossed over and back and through the 50-day moving average, finally made its last bottom. But notice the 50-day moving average was still curving roughly down, and it wasn't until it crossed over it, tagged it again, went up, broke it the second time, coming back up, and then started to find its way higher by riding the 50-day moving average up. If you think the bottom is in, say, in energy stocks, it probably isn't. Bottoms are processes, and it is most likely that this sign here where we're seeing this cluster where it's not shooting higher and the moving average is still headed down means we're either going to see another bottom near this bottom or a deeper bottom as part of a larger bottoming pattern. That's kind of what my thoughts are on that. I want to look at emerging market stocks because everybody thinks the market's going higher. And when we look at emerging market stocks, they're really a good proxy for liquidity. And you can see that this is Steve's line of doom. If you're below the line of doom, then still bad things are yet to come. In order for the coast to be clear, you need to get through the line of doom and not see it for a while. And what did we see? Emerging markets appeared to bottom. V-shaped recovery. Ran into the line of doom. Nope. Ran into the line of doom. Nope. 50-day moving average still headed lower. And that indicates to me that the probabilities here is that emerging market stocks are headed down, and they're going to likely bring the broad market with them, because when we overlay the S&P 500, what you see is, even though they do not long-term follow each other, and you can't really use that, in the short term, what you can see is they do follow each other. So emerging markets are rolling over, kind of headed, looking like they're headed lower. The U.S. equities are trying to head higher and say, no, everything's okay. But if emerging markets start to head down, guess where U.S. stocks are headed down? They are headed lower. Now, one of the great things about macro is I talk about having multiple entry points. So many people know that if real yields go higher, as I suspect they will, that when they hit the peak and head down, it could be a big opportunity in the precious metal space. But gold seems to be going up, and everybody's super bullish gold right now. But when you look at gold in emerging markets, you can learn something. And I've said, even to my clients who have an interest in this, I said, look, I may miss the gold move. It's okay, because I got a backup plan that would be just as good, called emerging markets. Let me show you. So if we take the emerging markets chart and we overlay gold, so for me it's /GC, what you see here in the short term, let's go zoom out a little bit more, is gold is moving higher against emerging markets. And as we look back, let's go to a weekly chart, and I want to show you what's going on here. You can see the two have a decent relationship between them. So back following the leading into the great financial crisis, emerging markets were the thing to be in. And gold went up, but not as much. And when emerging markets came crashing down, well, why did it come crashing down? Because gold did not validate. And then the two moved up following the great financial crisis. That's when you know, hey, everything's cool because these two are moving together. And then what happened is emerging markets started to head lower, and gold said, no, man, we're in a major bull market here. Nope. Emerging markets said, sorry, pal, you're not. And because it didn't rally, gold came back down. And then the two went down together. So that was a good indication that liquidity was drying up. And then they started to head higher. And look, gold started, hey, we're going to outrun you, emerging markets. And they said, I don't think so. Get back down here. And then emerging markets says, I gotcha. I'm going to outrun you. And gold said, no, pal, you are wrong. And look, it brought emerging markets down. Now what's happening is you have gold front-running emerging markets. The question is, who is right and why? Well, from a macro view, first of all, anytime you have everybody that seems to be in one side of the camp, like I said, I could be wrong about this, and I might be, but it doesn't mean I don't have a backup plan. So I don't like things that everyone's already either in or overly bullish about. Why are people excited about gold? They think inflation's coming, but it's not coming. We know deflation's coming. And then they'll say, well, it does really well during deflation. Well, let's see, gold, it's like listening to one of those gold commercials. Hey, gold does well in inflation, deflation, stagflation, moderate inflation, low inflation. No, it does not do well in all the time. How about emerging markets? When you look at emerging markets countries, what do they do to get dollars? Because that's what we want to talk about, right? How do they get dollars? Well, they export. And what are there two types of things they tend to be major, or three types of things they are major exporters of? Commodities such as oil, agriculture, and metals, gold, copper, things like that. Well, are we seeing a major demand for things like oil and copper and things like that? No. So emerging markets are telling us that there is still a problem here, and gold is saying, you're wrong. And my view is one of these two is going to be right. And if emerging markets rolls over and heads down, guess what's going to do? It's going to yank gold lower, in my opinion, and then we'll get a conclusive bottom, and then both of them run up. Now, let's say I'm wrong. See, in the macro world, if you have more than one entry point, you can be wrong. And so you say, well, what if I'm wrong and this is the real gold bull market? Well, then guess what emerging markets are going to do? I could just hop on that train and I'll be like, boom, they're going to ride together. Because here you see, gold, or emerging markets are down, gold went up, gold pulled back and took off. Well, I still had an entry point for emerging markets if I missed it. And I've got that here. But I really believe that we're more likely to see emerging markets roll over and head down and bring gold with it, because emerging markets are telling me we're below the Steve's line of doom, and that's not good. So with that, I want to thank you for being with me here today. We'll be back on Monday where I actually will get to your questions. I really wanted to talk about the quantitative easing bit. I wanted to kind of get into some of these charts, talk about the moving average, look at yields and say, look, the interest rates are headed lower. Financial conditions are going to tighten. Emerging markets are telling us that. And while I may be wrong on gold, I have a hunch I'll probably be right. Anyways, I'm Steven Van Metre. I'll see you on Monday. Thanks for watching. The content of this video is provided as educational information only and is not intended to provide investment or other advice. It shows not to be construed as a recommendation or solicitation by or selling security, financial instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre. Our own personal capacity, the opinions expressed in this video that alone do not reflect the view of Alice Financial Advising or Steven Van Metre Financial.